Welcome to Talk Tickers. So, in today's deep dive, we are jumping into a situation that, well, imagine a legendary rock band.
Okay, I'm with you.
They've been playing the exact same hit song for a decade. And suddenly they try to drop this highly experimental, super complex electronic album.
Oh, man. That usually doesn't end well.
Right. They're standing on stage, staring out at this massive, incredibly loyal fan base. But the market, the fans, the critics, the institutional investors, they're all ruthlessly crossing their arms.
Just waiting to judge it.
Exactly. Everyone is waiting to see if this new sound can actually top the charts, or if this band should just, shut up, play the classic chords, and fade into legacy status.
That is a perfect analogy for what we're looking at today.
Yeah. We've got a massive stack of source material for you today. We're looking at DocuSign's Q4 fiscal year 2026 earnings release, their freshly filed 10K, and a pretty thick folder of Wall Street analyst notes.
And the mission here is really to figure out if their massive pivot into AI can actually reinvent the company.
Because if you're an investor, you've probably watched this stock just severely underperform over the past 12 months.
Oh, absolutely. It's been rough.
People have been sitting in this brutal holding pattern, just waiting for a catalyst. So this specific quarter is a massive show me moment.
It really is. And looking at the data, the market's reaction to this show me moment was highly revealing, actually.
How so?
Well, we're looking at a post-market price reaction that bumped up pretty modestly. It settled somewhere in that 1.4% to 2.3% range.
Which doesn't sound like a lot.
It doesn't. But if you pull the options chain data from the week prior, the options market, which, measures anticipated volatility and fear, it was pricing in a massive 9.6% move in either direction.
Wow, almost 10%.
Right. So the fact that we settled into this very quiet, low single-digit green territory, that tells us the fear of a catastrophic miss was entirely unfulfilled.
It's basically a massive sigh of relief.
Exactly. Wall Street looked at the execution outlined in the 10K and essentially concluded, okay, the bleeding has stopped.
The core business didn't fracture.
Yeah, the transition is holding. Now the scrutiny just shifts to whether this new platform architecture actually has the momentum to drive future enterprise adoption.
But the baseline for that momentum has to be the current financial reality.
Mm-hmm.
I mean, we can talk about AI architecture all day, but if the core business is degrading, the tech doesn't even matter.
100%.
So let's do a rapid-fire snapshot. Let's look at the headline numbers they delivered in Q4 to really anchor our understanding here.
Sure. So the headline beats were structurally sound across the board. On the bottom line, they delivered non-GAAP earnings per share of $1.01.
And what was the street expecting?
The consensus was sitting right around 95 cents, so a clean beat there.
Nice.
And if you strip away all the adjustments, so looking at the GAAP EPS, the raw accounting reality that includes things like stock-based compensation, they hit 44 cents.
Okay, and how does that compare to last year?
It's a very healthy operational step up. They posted 39 cents in the exact same quarter a year ago.
Okay, so we're seeing profitability exceed expectations, not just on the adjusted basis, but in the raw, unadjusted metrics too.
Exactly.
But, beating the bottom line is often just a function of financial discipline. You can't sustainably cost-cut your way to long-term hypergrowth.
Right, you eventually run out of things to cut.
Yeah. You have to look at the top line to see if the market is actually buying what you're selling.
Well, Q4 revenue came in at $836.9 million.
Which beats the $827 million consensus.
Yep. And it represents an 8% year-over-year growth rate. But honestly, the metrics that management is really going to emphasize to institutional investors are the cash and billings milestones.
Oh, right. Because they crossed a massive threshold here.
Huge. For the very first time in the company's entire history, Q4 billings surpassed the $1.0 billion mark.
$1 billion in a single quarter.
Yeah, up 10% year over year. And simultaneously, free cash flow for the full fiscal year topped $1.0 billion too.
That is, when a software company starts measuring its quarterly billings and annual free cash flow in the billions, it just completely changes the capital allocation math.
It really does. It's a totally different game.
Because the immediate question for any board of directors when you have $1 billion in free cash flow is, well, how do we deploy this without destroying shareholder value?
And their answer was pretty loud and clear.
Yeah, a massive $2.0 billion increase to their share repurchase authorization.
It's aggressive.
It is. Combined with their existing capacity, that brings their total buyback firepower to a staggering $2.6 billion.
Which is wild. The sheer size of that buyback relative to their current market cap, it's a massive structural signal. They're basically screaming to the market that they view their own equity as heavily mispriced.
But, like we always say, a billion-dollar billings quarter doesn't just materialize out of thin air.
No, it definitely doesn't.
And a $2.6 billion buyback is only sustainable if that underlying operational engine is actually durable. We really need to look under the hood at the revenue mix.
Let's do it.
We need to see if this is just some temporary spike driven by, I don't know, seasonality, or if it's a sustainable structural advantage.
Well, if we break down the load-bearing pillars of that $836 million in Q4 revenue, it's the predictability that really stands out.
How much is recurring?
Subscription revenue accounted for $819 million of the total.
Wow. So that's what, roughly 98% of their entire top line?
Exactly. 98% is recurring software as a service revenue.
So this isn't lumpy, unpredictable professional services or hardware setups.
No, it's highly predictable. Their total annual recurring revenue, or ARR, ended the year at $3.272 billion. That's up 8% year over year.
Though, to be fair, we do need to factor in that foreign exchange gave them a slight tailwind, right?
Yeah, FX provided an 80 basis point benefit to Q4 revenue, plus a slight bump from some digital add-ons they launched late last year.
Still, that 98% subscription mix is kind of the holy grail for software multiples.
It is, because it provides visibility. And that visibility is underpinned by just massive customer scale. I mean, total customers grew 9% year over year, pushing past the 1.8 million mark.
1.8 million customers. But really, the metric that dictates their future as a true enterprise platform is their traction with the massive global corporations.
Right, the whales. And they now have 1,205 customers spending over $300,000 annually.
That's a huge commitment.
Yeah, and that cohort grew 7% year over year. Furthermore, their international revenue just crossed a major threshold. It now makes up over 30% of total Q4 revenue.
And it's growing at what, 15% year over year?
Exactly, which is huge because exporting this kind of platform globally requires intense localization.
Right, you're navigating totally fragmented legal jurisdictions, integrating with regional identity networks. It's not easy.
It's extremely difficult. So the fact that international is growing at nearly double the rate of the total business indicates their regional compliance architecture is highly effective.
Okay, so you're highlighting all this operational strengths and global scale. But when I look at their 10K, I see a glaring contradiction in their margin profile that we have to talk about.
Okay, lay it on me.
They're generating $1 billion in free cash flow, right? But their non-GAAP gross margin actually shrank.
Yeah, it dipped.
It fell 50 basis points year over year down to 81.8%. But simultaneously, their operating margins expanded.
Right.
How does a mature software business experience shrinking gross margins, which, measures the fundamental costs of actually delivering the product while at the same time expanding its operating margins?
It's a great question. You really have to separate the mechanics of delivering the software from the mechanics of running the corporate entity itself.
Okay, unpack that for me.
So that 50 basis point dip in gross margin, that directly reflects the cost of goods sold. And right now, that is almost entirely driven by ongoing cloud infrastructure migration costs.
Wait, so they're changing cloud providers?
They are fundamentally re-architecting how they host and deliver their platform. And when a company of this scale moves massive, heavily encrypted data workloads across different cloud environments, they essentially have to run duplicate systems concurrently.
Oh, I see.
They have to maintain the old legacy infrastructure to keep current customers online while simultaneously spinning up and testing the new infrastructure.
It's essentially the equivalent of paying double rent.
That is exactly what it is.
Like, if you're moving your corporate headquarters, you're stuck paying the lease on the old building while you're outfitting the new building.
Right.
So the costs are artificially inflated. But the obvious question is, well, when does the old lease expire? When do we actually see these gross margins normalize and reflect the true cost of the new architecture?
Well, based on the earnings call commentary, this is a transitional penalty. They expect it to begin to ease heavily as they move into fiscal year 2027 and officially decommission the legacy infrastructure.
Okay, but then why didn't their overall profitability collapse under the weight of that double rent?
Because of intense operational leverage further down the income statement.
Oh,
Despite that gross margin compression, their non-GAAP operating income hit $247 million in Q4, and their operating margins expanded 70 basis points to 29.5%.
wow.
In fact, for the full fiscal year 2026, their operating margin hit 30% for the first time in company history.
Okay, but we have to scrutinize how they actually achieved that operating leverage.
Sure.
Because mathematically, if gross margins are down, the only way operating margins go up is if they're drastically cutting costs in sales and marketing or research and development.
That's usually how it works.
But looking at their headcount, they ended the year with 7,044 employees.
Right.
That's an increase. They added over 200 people compared to the 6,838 they had a year ago. So how in the world are they claiming operational leverage and margin expansion when they are actively growing their headcount?
It's all about geographic arbitrage and realignment. It's not just raw headcount reduction.
What do you mean by geographic arbitrage?
So the vast majority of their net new headcount is being strategically located in lower-cost geographical regions way outside of traditional tech hubs.
Ah, so they aren't hiring in Silicon Valley.
Exactly. They're hiring engineers and support staff in markets where the compensation requirements are fundamentally much lower. Meanwhile, they're allowing natural attrition to kind of thin out the higher-cost legacy roles in expensive cities.
That is clever.
Yeah, they've managed to completely decouple their revenue growth from their compensation growth. They grew the top line by 8% without having to grow their total compensation expense by anywhere near that amount.
And I guess that structural efficiency flows straight into the cash flow statement.
It absolutely does.
Because Q4 free cash flow was $350 million. That's up 25% year over year, generating a massive 42% free cash flow margin.
Think about that.
I am. For every dollar of revenue coming in the door, 42 cents flows directly to the bottom line as unencumbered cash.
Which is phenomenal. They did note this was partially driven by collection efficiency and seasonal billing cycles, but honestly, regardless of the quarter-to-quarter lumpiness, their balance sheet is just impenetrable.
Yeah, they hold roughly $1.1 billion in cash and cash equivalents.
And zero debt.
None at all.
Zero.
Well, the absence of debt paired with that cash generation is exactly what enables their highly aggressive capital allocation strategy.
Precisely.
Like we mentioned, in Q4 alone, they executed $269 million in share repurchases, which is the largest single quarterly dollar amount they have ever deployed for buybacks.
Then if you look at the entire fiscal year, buybacks consumed 82% of their total free cash flow.
That's a huge chunk.
It gets crazier. If you factor in the cash they utilized to offset taxes on restricted Stark unit vestings for their employees, they functionally spent over 100% of their free cash flow just on managing their share count.
Over 100%.
Yeah.
But, the mechanics of how they are actually executing these repurchases is vital for investors to understand.
Oh, totally.
Because they aren't just sitting in a boardroom subjectively deciding, oh, the stock looks cheap today, let's buy it.
No, not at all. They launched a 10b-51 program.
Exactly. And for you listeners out there analyzing corporate governance, a 10b-51 plan is a highly structural tool.
Can you explain how it works for those who might not know?
Sure. So corporate executives and the company itself are subject to strict closed window periods. These are blackout periods, often spanning weeks before an earnings release, where they possess material non-public information.
Right. They know the numbers before the public does.
Exactly. And during those blackout periods, they are legally forbidden by the SEC from buying or selling their own stock, no matter how irrational the market pricing becomes.
So if the stock tanks for no reason during a blackout, they can't step in to defend it?
Normally, no. But a 10b-51 plan solves this by handing the execution over to a blind algorithm.
Oh, interesting.
Yeah. The company establishes a predetermined set of rules with a third-party broker while the trading window is open. So they could dictate parameters like, hey, if the stock falls below $50, purchase $10 million worth of shares daily.
And then it just runs on autopilot.
Right, because the algorithm executes automatically based on those preset conditions. The company can actively buy the dip even when their executives are locked in a blackout period.
That is powerful. And by utilizing that mechanism, they've already scooped up $158 million in Q1 alone.
Just automatically.
Yep. And the net result of all this sustained financial engineering is a material contraction in their equity base. Their diluted share count dropped from 214.5 million shares down to 204.7 million shares.
So they are artificially engineering earnings per share growth simply by shrinking the denominator.
Exactly.
But, financial engineering has a hard ceiling.
It does.
You can optimize the cash flow, you can shrink the share count, you can relocate headcount to lower cost geographies, but eventually you just run out of fat to trim.
You can't shrink your way to greatness.
No. If a software company wants to command the premium valuation multiples they historically enjoyed, they require a fundamentally new growth engine, something that massively expands their total addressable market.
Which forces us to analyze the most critical strategic shift outlined in their filings. The pivot to Intelligent Agreement Management, or IAM.
This is the big one.
Yeah, because for years, the enterprise market viewed this company as a singular, highly commoditized utility. You have a finalized PDF, you need a digital signature for compliance, you use their tool.
It was basically a point solution at the very end of a really long corporate process.
Right. But the IAM platform is an attempt to own the entire agreement workflow stack. It's the transition from being just the digital ink to becoming the centralized operational brain for corporate legal departments.
And after being in the market for roughly 18 months, the early scale metrics for IAM are actually accelerating. The product exited the fiscal year generating over $350 million in annual recurring revenue.
And that compositional shift is exactly what analysts are tracking closely, because IAM now constitutes 10.8% of the total company ARR.
Wait, what was it last year?
At the end of FY 2025, just 12 months prior, it sat at a mere 2.3%.
Wow. So they essentially quintupled its share of the revenue base in a single year.
Yes. And management's explicit target is to push that concentration to approximately 18% of total ARR by the end of fiscal year 2027.
Mathematically, that implies pushing the IAM business well past $600 million in ARR over the next 24 months.
Which is no small feat.
No. Driving that kind of enterprise adoption requires moving way beyond generic software upgrades. You can't just slap a new coat of paint on it.
Right, and they aren't. They are launching highly specialized functional extensions tailored for very specific corporate departments.
Like what?
They introduced IAM for HR and IAM for procurement. And the 10K outlines these deeply integrated capabilities, things like the agreement desk, AI-assisted review, dynamic workspaces, identity verification, custom data extractions, and SIM integration.
Okay, the ear IAM. We need to explain why a capability like SIM, which stands for System for Cross-Domain Identity Management, is so critical for enterprise adoption. It's easy to just treat it as another technical acronym.
Yeah, it's way more important than it sounds.
Because SIM functions as basically a universal automated VIP pass for corporate IT departments.
Give me an example.
So in a massive Fortune 500 company, when a new employee is hired, or say an executive is terminated, the IT department historically had to manually provision or revoke access across 50 different software applications one by one.
Right, taking away their Slack, their email, their software access.
Exactly, which is a massive security risk if someone forgets to revoke access to the contract database.
Right.
But NCIAM allows the central HR identity system to automatically communicate with the IAM platform.
Oh, that's seamless.
Yeah. The second an employee's status changes in the central directory, their access to highly sensitive legal agreements is instantly granted or revoked.
And enterprise CIOs absolutely demand that level of automated security before they will ever deploy a platform across tens of thousands of users.
Exactly. And when you embed yourself that deeply into the IT plumbing and into the daily workflows of HR and procurement, the software becomes incredibly sticky.
The numbers back that up too. Their dollar net retention, or DNR, which, measures how much existing customers expand their spending over time, that ticked up to 102% from 101% last year.
It's moving in the right direction.
But the critical data point management highlighted is that the early renewal cohorts for these new IAM customers are actually outperforming the company average.
Meaning,
once an enterprise adopts the IAM platform, they are renewing at higher rates and expanding their deployment faster than the legacy e-signature user base.
Okay, but to understand why that expansion is actually happening, we have to look at the real-world friction this platform removes.
Yeah, let's unpack the case studies. Management detailed the AON case study, which they internally referred to as Project Meridian.
Wait, AON, the insurance giant?
Exactly, a massive global professional services and insurance giant. And the insurance industry is functionally built on hyper-complex, bespoke contracts. We're talking reinsurance treaties, liability caps, regional compliance riders.
A nightmare of paperwork.
A literal nightmare. AON has hundreds of millions of these legacy agreements sitting in totally fragmented digital vaults.
Millions.
Hundreds of millions. And before a platform like IAM, if a new global maritime regulation passed Or if AON needed to understand their aggregate exposure to a highly specific type of supply chain liability, the process was entirely manual.
What did that actually look like?
They would literally have to deploy an army of paralegals and junior associates to manually open thousands of PDFs, read through hundreds of pages of dense legalese per document, and manually log the relevant clauses into a spreadsheet.
This must have taken weeks.
Weeks, and it cost a fortune in human capital. Plus, it was highly prone to human error.
So what does IAM change that?
Well, IAM ingests all of those millions of fragmented documents, uses AI to semantically map the relationships between the clauses, and turns the entire massive archive into a searchable, structured, intelligent database.
Wow. So general counsel can just query their entire historical contract repository as easily as searching a Google database.
Exactly. Instantly surfacing their exact liability exposure.
That is incredible. And the Bank of Queensland case study illustrates a completely different application of the platform, right?
Right.
Focusing on real-time execution rather than historical analysis.
Right. And notably, this specific deal was transacted via the Microsoft Azure Marketplace, which highlights how they're leveraging massive cloud ecosystem partners for distribution.
Oh, smart.
Yeah. But for the Bank of Queensland, they're utilizing the IAM platform to digitize their end-to-end customer onboarding process using real-time data validation and biometric identity verification.
Okay, walk me through the mechanics of that digital onboarding process.
Right.
Because the consumer isn't just signing a static PDF to open an account anymore.
Right. Exactly the opposite. The consumer applies for an account via a digital interface. The IAM system instantly requests and verifies their government-issued ID using AI-driven visual analysis.
Like scanning your driver's license.
Yep. And it simultaneously cross-references the data the consumer input against external financial databases via API integrations.
In real time.
In real time, it assesses the risk profile, dynamically generates a bespoke, legally binding agreement tailored to that specific consumer's verified data, and captures the digital signature.
So an onboarding process that traditionally required what? Physical branch visits, manual documents scanning, back office processing.
Days of work now collapsed into a seamless automated flow taking minutes.
That's a massive shift. But here's the thing, you cannot sell an enterprise-wide AI brain or a core banking automation engine using the legacy metric of price per signature.
No, that model is dead.
Right. If a CEO is adopting this to overhaul their entire legal department or their global HR onboarding, that rigid per-seat licensing model completely breaks down.
It doesn't scale.
So they had to invent a fundamentally new way to charge for the value they are creating, which introduces this shift to consumption-based pricing.
Yes. Starting in Q1, they are launching consumption-based subscription pricing for their enterprise customers.
How does that actually work?
So instead of a rigid contract mandating, say, 5,000 user seats or a strict cap of 100,000 digital envelopes, enterprises will purchase a flexible pool of usage credits.
Okay.
And the organization can burn those credits however they see fit across the entire platform suite. They can spend them on identity verification checks, AI data extraction runs, dynamic document generation, or just standard signatures.
Okay, but we have to evaluate the risk profile of that pricing transition. Because with the consumption-based model, aren't they introducing massive revenue volatility?
What do you mean?
Well, if the macroeconomic environment cools down and enterprise activity slows, fewer hires, fewer procurement deals, fewer M&A contracts, their revenue drops almost immediately because customers simply consume fewer credits.
Right.
Does this expose them to cyclical downturns in a way their old fixed-seat contracts didn't?
I mean, it absolutely introduces cyclical exposure. There's no denying that. But it is a highly calculated risk designed to accelerate enterprise adoption.
How does it accelerate adoption?
Because consumption-based pricing perfectly aligns the software's cost with tangible value creation. Look, if a procurement department utilizes the AI to extract and analyze data from 10,000 vendor contracts, saving 5,000 hours of manual legal review, they are highly incentivized to pay the consumption cost. The return on investment is immediate, measurable, and massive.
Right, they can literally see the hours saved.
Exactly. But more importantly, this model dramatically lowers the barrier to entry for the classic land and expand enterprise sales strategy.
Oh, it completely removes the upfront friction.
Completely. A Fortune 500 CFO might completely reject a massive multi-million-dollar fixed license for an unproven AI platform. But if the sales pitch is, hey, just purchase a small pool of consumption credits, deploy the IAM platform within a single regional HR department and measure the ROI yourself, The friction just disappears.
And once that specific department proves the massive time savings, internal adoption spreads organically.
Yep. The credit usage explodes, and the enterprise happily purchases larger credit pools. It transforms the sales motion from this combative, high-stakes negotiation into a collaborative value discovery process.
But, and this is a big but, to actually serve as the central operational brain for these massive corporate agreements, the underlying technology must possess unparalleled, highly accurate intelligence.
Right, you can't fake it.
A generic AI wrapper built on top of a public model is utterly insufficient when processing multi-million-dollar indemnification clauses.
Oh, it would be a disaster.
Which leads us to the fundamental technological moat outlined in their filings, their proprietary AI architecture and their aggressive ecosystem partnerships.
Yeah, the data moat is the core thesis here. Management announced that over 200 million private, fully consented enterprise agreements have been ingested into their Navigator Intelligent Repository.
200 million. And that metric is up from 150 million just a few months prior in December. Right?
They are ingesting tens of millions of highly complex private legal documents at a staggering velocity.
But the word private is the real differentiator here, and I think the market is struggling to price that correctly.
Totally agree.
In the broader AI landscape, foundational models like OpenAI's GPT-4, Google's Gemini, Anthropic's Claude, they're trained predominantly on the public internet.
They scrape Wikipedia, open source code, Reddit, public websites.
Exactly. But the most economically valuable data in the world does not exist on the public internet.
No, it's heavily encrypted and locked behind enterprise firewalls.
It's proprietary procurement vendor terms, heavily negotiated M&A structures, bespoke corporate compliance policies. Public large language models have zero visibility into this dark data.
Right. And because this company has built a customer-consented proprietary training library of 200 million private legal contracts, they are claiming massive performance advantages.
Like what?
Management stated that utilizing these highly specialized private libraries yields up to a 15 percentage point improvement in both precision and recall compared to models trained purely on public data.
So if you ask a generic public AI to locate the, indemnification clause regarding third-party software data breaches within a 200-page enterprise agreement,
it lacks the specialized training to understand the deep contextual syntax. It might hallucinate a response or miss subtle legal nuances completely.
But their proprietary AI understands the exact structural anatomy of legal agreements because it has been rigorously fine-tuned on 200 million of them.
Exactly. The performance advantage is clear, but honestly, the cost architecture is what actually makes the business model viable.
Right.
Management claimed a 50x cost optimization on AI processing compared to running direct prompts on standard large language models.
Okay, wait. We need to break down the mechanics of how a 50x cost reduction is actually possible. Because on the surface, that sounds like pure marketing hyperbole.
I know, it sounds ridiculous.
How does their architectural structure fundamentally differ from just, plugging a PDF into ChatGPT?
It requires understanding the difference between a direct prompt and a specialized architecture known as ARGRE retrieval augmented generation.
Okay, explain that.
So when a user takes a 100-page legal PDF, dumps the entire text into a standard LLM and asks a single question, that is a direct prompt. The LLM is forced to process tens of thousands of tokens, which are the computational chunks of text every single time a query is executed.
And compute costs are billed per token, right?
Exactly. So processing the entire document repeatedly requires astronomical compute power and is just financially ruinous at enterprise scale.
Okay, so how does ARGI change that?
Retrieval augmented generation completely changes the workflow. If a direct LLM prompt is like hiring a genius scholar, locking them in a massive library, and forcing them to read every single book cover to cover every time you ask a single question.
Exhausting.
Right. ARGRE is fundamentally different. ARGRE is the equivalent of hiring a highly efficient, meticulous librarian who has already indexed every single paragraph of every book in the building.
Oh, I see.
So when you ask a question, the librarian instantly retrieves only the 3 highly specific, relevant paragraphs, hands them to the genius scholar, and says, synthesize your answer based strictly on these 3 paragraphs.
Wow. That architectural shift requires a fraction of the compute power because the LLM is only processing a few hundred tokens instead of 100,000.
Exactly. Because this company has already structured, mapped, and indexed these 200 million documents within their proprietary Navigator database, they do not have to brute force the LLM queries.
They just retrieve the exact relevant clauses and only process those.
Yep. That underlying indexing infrastructure is what drives the 50x reduction in compute costs, which preserves their gross margins while delivering AI capabilities.
And they're also highly pragmatic about their position in the broader software ecosystem, too.
They have to be.
Yeah. They are not attempting to build a walled garden and force every user into their specific interface. They have cultivated an ecosystem of over 1,100 integrations.
And the most significant recent development is their partnership with Anthropic, integrating IAM directly into Claude Cowork via an MCP.
A Model Context Protocol connector.
Yes. And they also maintain deep integrations with OpenAI's ChatGPT, Google Gemini, GitHub Copilot, and Salesforce's Agentforce.
The Model Context Protocol is a vital standard to understand here. MCP essentially acts as a secure, standardized bridge, allowing external AI models to interface with specific data sources.
Right, because enterprise users are highly resistant to adopting new software interfaces if their daily workflows are already entrenched somewhere else.
Exactly. If a corporate legal team spends their entire day communicating inside Salesforce or collaborating via Anthropic's Claude, making them log into a standalone platform creates massive friction.
So by utilizing the Model Context Protocol, they are enabling these external world-class AI chatbots to securely query their proprietary index document repository.
They are positioning themselves as the underlying system of action.
Yes. They don't care if the general counsel types their query into an Anthropic user interface or a Salesforce dashboard. As long as the IAM engine is powering the deep data retrieval and executing the secure workflow in the background, they capture the consumption credit and the revenue.
And the tangible ROI proof points resulting from this architecture are striking. Consider the Vestwell case study. They're a venture-backed fintech infrastructure company.
What did they see?
They integrated the IAM platform directly into their existing customer relationship management system. The time required for their teams to manually draft, verify, and execute a new, highly complex customer agreement package plummeted from 75 minutes down to just 5 minutes.
A process that consumed well over an hour is now executed in the time it takes to brew a cup of coffee.
Insane. Another one was Payworks, a workforce management software provider. They integrated IAM workflows deeply into a really complex Salesforce setup.
And what were the results there?
Their 24-hour contract completion rate, which is the percentage of contracts signed and finalized within a day of issuance, skyrocketed from 55% to 87%.
That's a huge jump.
Because the friction of manual follow-ups, document formatting, and identity verification was totally automated away by the AI, they recovered $400,000 in annual sales representative productivity.
Wow. So their sales reps are no longer acting as administrative assistants chasing down missing signatures?
Exactly. The platform handles the execution, allowing the reps to focus entirely on revenue-generating activities.
But you know what provides the strongest validation of this technological shift? It's their internal dogfooding.
Oh, they're using it themselves.
Yeah. Heavily. They are not merely selling this AI vision to the market, they are fundamentally rewiring their own internal operations. Management explicitly noted that the vast majority of their own engineering workforce utilizes AI continuously. In fact, 60% of all new code being written at the company now is classified as AI-assisted.
So if we synthesize everything we have analyzed from these sources, they possess a $350 million hypergrowth IAM product, a massive, highly defensible proprietary data moat built on 200 million private documents, a 50x architectural cost advantage in AI processing via RA, and an impenetrable balance sheet generating $1 billion in free cash flow, heavily protected by a $2.6 billion buyback program.
Sounds like a dream scenario.
Right. If we concluded our analysis right here, the logical assumption would be that this stock is trading at a massive premium, up 40% on the year. But the forward guidance for fiscal year 2027 sharply contradicts that hypergrowth narrative.
This is where the mathematical gravity of their legacy business asserts itself, and we really must scrutinize the exact numbers they provided to the street.
Let's examine the guidance matrix.
Okay, for Q1, they expect total revenue to land between $822 million and $826 million. Non-GAAP gross margin is projected at 80.8% to 81.2%, absorbing those ongoing cloud migration costs we talked about. while operating margin is targeted at 29.0% to 29.5%.
And moving to the full FY 2027 projections, total revenue is guided to a range of $3.484 billion to $3.496 billion. Non-GAAP gross margin is expected to tick up slightly to a range of 81.5% to 82.0%, and operating margin is projected to remain incredibly robust at 30.0% as the primary health metric. They are elevating ARR, annual recurring revenue, as the new ultimate North Star.
And the ARR guidance is where the friction with the market lies.
Definitely. They are targeting 8.25% to 8.75% ARR growth for FY 2027, which would land at approximately $3.551 billion at the midpoint of the range. Let's do the actual arithmetic here, because this is the fundamental tension in the stock. If the new IAM platform is growing exponentially, nearly doubling its share of the business and exiting the year at $350 million, why is the total company ARR growth only guided to around 8.5%?
It's a fair question.
They grew ARR at 8% last year. Guiding to 8.5% is technically an acceleration, but it's an incredibly sluggish, modest acceleration. Why isn't a company with a wildly successful enterprise AI platform breaking decisively back into double-digit 15% growth territory?
It is entirely due to the denominator problem, which is arguably the most difficult mathematical hurdle for any legacy software company attempting a platform pivot.
Walk me through the math.
Let's break down the composition of their revenue base. They have a total ARR of roughly $3.27 billion. The hypergrowth IAM business accounts for $350 million of that total.
Right.
By simple subtraction, that means the legacy e-signature business, the core, highly mature, heavily penetrated product, is sitting at roughly $2.9 billion. So even if the $350 million IAM business compounds at 40%, 50%, or 60% over the next 12 months, it is attempting to drag a massive $2.9 billion anchor up a hill.
The immense weight of the legacy denominator fundamentally suppresses the blended average growth rate.
Exactly. The legacy e-signature market is highly saturated. It is still growing, but it is growing at a slow, mature pace. Mathematically, it does not matter how rapidly the IAM engine accelerates right now. It simply lacks the sheer scale required to overwhelm the gravitational pull of that $2.9 billion legacy base.
That makes total sense. The transition just requires structural patience. It is a compositional shift that plays out over years, not quarters.
Exactly. As IAM grows from 10.8% of the business to 18% and eventually 25% or 30%, its high growth rate will carry progressively more weight in the blended average, naturally accelerating the total company growth rate over time.
And management was highly transparent regarding the 3 specific execution levers required to navigate this transition and eventually return to aspirational double-digit growth.
Yes, let's hit those. The first lever is the obvious one. Sustaining the hyper-growth of IAM by aggressively cross-selling the platform to their massive existing customer base and landing new enterprise logos.
And the second lever is defensive. They must maintain flat or slightly improved gross retention rates within the massive legacy e-signature business. They have to ensure that the $2.9 billion anchor doesn't begin to shrink and actively offset the revenue gains generated by IAM.
And the third lever is operational. They need the gross margin pressure from the cloud infrastructure migration to materially ease in the latter half of FY27.
They need those gross margins to normalize so they can redirect that capital into aggressive R&D reinvestment without compressing their 30% operating margins.
Right. Furthermore, management explicitly noted they will only update these ARR forecasts as underlying enterprise bookings expectations evolve throughout the year, and historically, those are heavily weighted toward their fiscal Q4.
So the market is not going to get instant gratification. They're going to have to wait.
And institutional investors absolutely despise waiting for mathematical transitions.
They really do. This slow, quarters-long grind to fundamentally change the composition of the revenue base provides the macro context for how Wall Street is currently digesting this narrative. We need to step back from the micro-mechanics of the 10K and look at the broader sector dynamics.
Right. Analyzing the historical context of the stock's performance leading into this print explains the deep skepticism. Over the preceding 3-month period, the stock had sold off by roughly 30%.
30% in 3 months.
Yeah. And over a 1-year look back, it had suffered an agonizing 43% decline.
And if we compare that to the broader software ecosystem, the divergence is stark. The IGV software ETFs, which tracks the broader sector, was down about 18% over that same 3-month period due to macroeconomic rate fears, but it was only down 7.9% over the 1-year period.
So this specific stock was not merely drifting downward with the broader market tide.
No, it was badly lagging its peers and being uniquely severely punished by institutional capital.
The localized sell-off was driven by an existential fear that has plagued the entire legal tech sector, the fear of imminent AI disruption. The market has been gripped by a terrifying thesis regarding this specific company. The fear is that advanced public LLMs will rapidly commoditize basic digital signing and contract review.
I mean, if an enterprise can simply use a generic AI tool integrated into their existing word processor to instantly draft, review, and execute a contract at zero marginal cost, the entire legacy e-signature software category theoretically becomes obsolete overnight.
Exactly. The market priced in a high probability of technological extinction.
And the core objective of this earnings call was to violently combat that AI will kill you narrative.
Which they did. Based on the 10K filings and the subsequent analyst notes, management successfully inverted the thesis.
They utilized that $350 million IAM run rate as empirical proof that AI is not a disruptive threat to their business model. It is a massive accelerant.
They argued that because they possess the 200 million proprietary documents, the dark data that open source models cannot access, they are uniquely positioned to build the most accurate, defensible AI platform in the space.
And the institutional sell-side notes published after the call reflect a pretty significant shift in tone.
Oh, universally. Analysts acknowledged the strong Q4 financial beat, the fortress-like cash flow generation, and the undeniable early market leadership of the IAM platform.
However, the modest after-hours price movement, settling up 1.5% against a highly volatile option setup that predicted a nearly 10% swing, indicates that while the existential fear has subsided, the market views the platform pivot as promising but not mathematically proven.
Yeah. The market is observing this company like a highly rated, incredibly talented rookie draft pick who just delivered one undeniably phenomenal performance.
Exactly. The underlying talent is obvious. The fundamental metrics from this specific quarter look fantastic. But the seasoned institutional scouts are refusing to buy the jersey and declares him the MVP until they witness an entire season of consistent, compounded execution.
They've been burned by software transition stories before.
So to synthesize the current market psychology, it was a highly constructive, bullish quarter. Management definitively stopped the bleeding and stabilized the narrative. They proved the IAM product has real, monetizable traction within the Fortune 500.
And most importantly, they heavily protected the downside risk by deploying that massive $2.6 billion buyback authorization as a structural floor.
But the true re-rating catalyst, the inflection point where the stock breaks out and multiple expansion aggressively occurs, will not happen until that total company ARR cleanly and decisively breaks back through the 10% growth barrier.
Until the denominator problem is mathematically resolved, investors will demand multiple quarters of compounding IAM growth.
So we find ourselves in a fascinating, highly structured holding pattern. The downside is heavily protected by an impenetrable balance sheet and programmatic share repurchases, but unlocking the massive upside requires deep structural patience.
Which is hard for the market.
Very hard. But looking at the institutional analyst notes in our source stack, the sharpest funds on Wall Street are positioning around two highly specific trade ideas to exploit this exact dynamic.
Let's get into it.
Let's deconstruct the logic behind them in our not financial advice segment.
But we must state unequivocally before proceeding. This analysis is purely for educational, informational, and entertainment purposes. We are deconstructing institutional frameworks based on public data. Absolutely no content discussed during this deep dive constitutes financial, legal, or investment advice. Do not execute trades based on a podcast discussion.
Exactly. With the necessary disclaimers firmly in place, let's look at the first strategy institutional funds are deploying. It revolves entirely around the capital structure. Let's call it the fortress floor volatility play.
Okay, the foundational setup for this trade relies on the $2.6 billion authorized buyback capacity resting on a market capitalization that has been severely historically compressed by that 43% drop.
Crucially, as we discussed, management is not merely holding that authorization as a theoretical deterrent. They are structurally mandated to acquire shares via their automated 10b-51 algorithmic trading program.
They're operating as the ultimate corporate whale, legally committed to aggressively purchasing their own equity if the price deteriorates.
Because that massive capital floor exists, funds are aggressively writing or selling out-of-the-money put options on 30 to 60-day expirations. Walk through the mechanical logic of why selling puts is the preferred vehicle here.
It exploits the residual implied volatility. Coming into this print, the options market was terrified of the AI disruption narrative, pricing in near 10% implied moves. When fear is structurally elevated, the premiums, the actual cash price you receive to sell a put option, become incredibly inflated.
Okay.
By selling those out-of-the-money puts, an institution is essentially acting as a highly capitalized insurance company for terrified retail investors. The institution is making a structural, mathematical bet that the $2.6 billion buyback acts as a synthetic, unyielding put option for the entire market.
Meaning, if broader macroeconomic fears cause the stock to drop, the 10B51 algorithm automatically triggers, creating a massive price-insensitive floor of demand that prevents a catastrophic technical slide.
Exactly. The institution collects the heavily inflated premium driven by the lingering AI disruption fears, but their actual downside risk is heavily backstopped by a management team deploying billions in cash to defend the valuation.
You are arbitraging the market's irrational fear against the company's highly rational, mathematically programmed balance sheet defense.
Yeah.
That is fascinating.
Yeah. The second strategy surfacing in the analyst notes is a broader structural play on the legal tech sector itself. We can frame it as the agreement economy pairs trade.
All right. A pairs trade involves going long on one specific asset while simultaneously shorting another highly correlated asset. The goal is to isolate a specific fundamental thesis in this case, the divergence in AI data architecture, while entirely removing broader macroeconomic or sector-wide risk.
Right. If the entire software market crashes, the short position profits and offsets the long position.
So what is the specific setup here?
The setup attacks the lazy market narrative that all legacy software will be equally disrupted by AI. This specific company is proving they can successfully pivot to an AI-native IAM platform because they possess a proprietary data moat, 200 million private legal documents that public LLMs simply cannot access or replicate.
So the trade execution involves going long on this specific stock while aggressively shorting a fragmented legacy contract lifecycle management pure play, or shorting a generic workflow software startup that relies entirely on public API wrappers.
Right.
Let's define an API wrapper for clarity. An API wrapper is essentially a software company that possesses zero proprietary technology or specialized training data. They simply build a clean user interface, take the customer's input, send it via an API key to a public model like OpenAI, receive the response, and display it to the user. Why is a short side of this pairs trade fundamentally doomed?
Because of the architectural shifts we discussed earlier. With the introduction of consumption-based enterprise pricing and their direct integrations into Claude, ChatGPT, and Salesforce via the Model Context Protocol, the company we are analyzing today is going to brutally and systematically cannibalize those smaller, single-point legal tech solutions.
That makes sense. If a Fortune 500 CIO is evaluating their software stack, why would they pay a separate expensive licensing fee for a flimsy AI contract review tool that is just a thin wrapper built on top of public ChatGPT?
They wouldn't. They would utilize their core trusted e-signature provider, who now offers a highly accurate proprietary RG-based AI system that is finely tuned on 200 million private documents, and they would simply pay for it using flexible consumption credits.
The thin wrapper companies provide zero marginal value and will be aggressively consolidated out of the enterprise budget. You're going long the deep proprietary data moat, and you're shorting the highly commoditized, defenseless API wrapper space.
Exactly. However, any institutional analyst must constantly monitor the blow-up risk of a pairs trade. The existential threat to this specific thesis involves the hyperscalers. What occurs if a titan like Microsoft determines that intelligent agreement management should not exist as a separate software category, but rather as a native, deeply integrated feature within Office 365 and Azure? If Microsoft leverages their own immense enterprise data troves to offer a comparable platform at zero marginal cost to their existing user base, it would obliterate the pricing power of the entire legal tech sector.
That is the ultimate macro risk.
Yeah.
The counter-argument, heavily emphasized in the 10K, is that their recent deep integration with the Azure marketplace, specifically highlighted by the Bank of Queensland deal, strongly suggests Microsoft currently views them as a highly valuable ecosystem partner driving massive Azure compute consumption, rather than a direct competitor to be squashed.
But in the ruthless landscape of enterprise software, strategic alliances can shift rapidly.
So true. Well, we've extensively analyzed the financial mechanics, the architectural shifts, and the market psychology surrounding this earnings report. The foundational takeaways for anyone tracking this space are clear.
The cash flow generation is undeniably elite. $1 billion in free cash flow provides massive operational flexibility. The $2.6 billion stock buyback program establishes a highly structural floor to the valuation, protecting the downside while they execute the pivot.
And the $350 million IAM business represents the rapidly compounding growth engine of the future, entirely powered by a proprietary AI data advantage that public models cannot easily replicate.
The muted market reaction is simply a function of waiting for the mathematical reality to align with the strategic vision. The market is patiently waiting for the denominator problem to resolve, pushing total ARR growth back into the double digits.
As we wrap up our analysis, I want to reiterate our earlier disclaimer. We are analyzing public data, 10K filings, and exploring strategic frameworks. Absolutely no content discussed on this deep dive is financial, legal, or investment advice. Always consult with a licensed professional before making financial decisions. To close this out, I want to circle back to the opening hook regarding the legacy rock band attempting to drop a complex electronic album. As we have dug into the actual technology of what they are building, an AI architecture capable of ingesting, semantically analyzing, biometrically verifying, and executing hypercomplex legal agreements in a matter of seconds, it raises a profound, almost philosophical question regarding the future of corporate governance.
Yeah, it really does.
I want to leave you, our listener, with this final provocative thought to ponder over your morning coffee. If an AI system can perfectly negotiate a commercial contract, draft it with hyper-precision based on hundreds of millions of historical data points, verify the biometric identity of the human signers in real time, and execute the flow flawlessly, at what specific point does human legal review stop functioning as a necessary safeguard and start functioning purely as an operational bottleneck?
That's a scary thought.
And more importantly, when autonomous bots agree to a complex, multi-million-dollar liability clause that no human lawyer actually read or comprehended, who exactly owns the legal liability when a systemic failure occurs? Is it the corporate entity, the AI model provider, the platform hosting the agreement?
The fundamental nature of corporate trust and legal liability is shifting beneath our feet.
I challenge you to review your own enterprise software stacks this week. Look closely at how many distinct, fragmented applications you're currently utilizing simply to manage contracts, procurement flows, and HR onboarding. Ask yourself, would you consolidate all of that fragmented friction tomorrow if a single, secure AI platform could automate it?
That is the massive billion-dollar bet this company is making.
Thank you for joining us for this deep dive. Stay analytical, keep questioning the consensus, and we will see you on the next episode of Talk Tickers.